Hi there. Trade credit is the other part or the other side of the coins of borrowing. So instead of borrow from the bank, and you know the bank will charge its interest, whether it is a conventional bank, that is, it take the interest, or it is an Islamic bank will take its profit sharing. And believe it or not, sometimes the profit sharing is exceeding the interest. So there is another way to bring finance to the business, and which we discuss it again today, and we'll repeat it now as we call it the trade credit, or if you want to call it the accounts payable financing. So it is another meaning of, say, buying supplies or goods or services on a credit, which means you will pay later rather than paying the cash now. So you can benefit from this cash, okay, and okay for other, for example, commitments. Now, but again, you have to be very careful here. You always scale the benefits and the costs. Always make cost and benefit analysis, and especially if there is also let's say discount or cash discount, as we say. Sometimes the supplier offer cash discount for prompt payment. Okay, so in this case, again, you have to be very careful, and then you say, well, shall I pay, let's say, within 30 days and get 2% discount, or shall I wait, for example, up to 70 days and get no discount, but I will benefit, say, of the cash within 40 days, and I can use this 40 days cash to settle my other, commitment, or to make, for example, another investment in my business. Yes, you have to, sorry for that. You have to compare it, as I said, and you have to say, well, the opportunity cost is 2% here, whether to get it or to forgo or to forget it. So this cost forgone is your opportunity cost. Now, if you want to analyze this opportunity cost, and let's calculate the opportunity cost percentage, well, you will say that, let's say, 365 days in a year. So you have to divide it by this 40 days, which is the difference between 70 days and the 30 days credit, and then you have to multiply it by the 2%. You will end with nearly 18.3%, or let's even say 13. So the opportunity cost here as a percentage is 18.3%. Now, believe it or not, some businesses will borrow money from the banks to pay their suppliers on time to gain the discount. Of course, after comparing the bank interest with this opportunity cost with 2%. And in practice, we notice that, yes, this discount is usually exceeding, as a benefit for you. As we say, you are the buyer, and in your book will be in your box will be your discount received as an income, whereas for the seller will be discount allowed and expense. Okay, and you will notice that, yes, it's usually exceeding the bank interest. So you will benefit from that. Okay, and you will pay on time, and then benefit from this discount, and then, of course, enjoying either, let's say, your supplies, you sell them on credit, or you sell them on cash, you sell at higher price, you make more profit, more cash. There is another way, of course, to bring some finance to the business, which we'll discuss it later on, but I will mention it very quickly here and explain it next session. It is the aging of your customer, or the aging of your receivable, which means you have to sell your customer definitely at lower price. Of course, the total of good customer, you have to sell them, okay, to other companies, let's say they are equal to 100,000, you sell them for, let's say, 95,000. Yes, you lose the opportunity cost is 5,000, but you will gain the cash. You will bring some liquidity in the business, and you will avoid the bad debts or the provision for doubtful debts in your books. Thank you very much. See you next time.